The U.S. Fed has slashed its key interest rate by 50 basis points. Will Tiff Macklem and the Bank of Canada step up to the plate with a big aggressive swing of their own? Meanwhile, up here in the Great White North, our finance minister, Chrystia Freeland, seems to think that first-time homebuyers shouldn't have to follow any mortgage rules at all. In the words of the immortal Ozzy Osbourne, these mortgage headlines are driving me insane. We're going off the rails on a crazy train. All right, all aboard. Well, not all aboard. We're actually missing Kristen today. She's got the week off, and hopefully we'll see her again next week. So I'm here with Sean. I'm Vaughn. We're mortgage people, and we've got probably one of the bigger podcasts to explore today. We have two big pieces of news this week. The first one is the Fed rate cut in the U.S. This is their first rate cut since COVID. Canada led the way with the rate cuts, and then the U.S. tries to upstage us with a big 50 basis points cut. But they're also playing catch up. So we can pat ourselves on the back here too. Sean, what's your take?
Yeah, I think it certainly feels like a crisis mode cut. They probably wish they cut at the last meeting now, and now they have to do 50 basis points. With the more information they have, the economy is slowing faster than they would have hoped. And they had to do a 50 basis point rate cut. It does open the door a little wider for a Canadian rate cut, but we've already had 3/4 points going again in October, going again in December. Seems like, we've been talking about this for weeks now. That's going to happen. So I think certainly the door is open, but I don't think the Bank of Canada feels like they're behind like the U.S. Federal Reserve does.
Well, and it shrinks that spread between our key interest rates as well to under 1%, which is always like the safety. It's always the kind of concern that we want our economies running kind of at the same level so that our cost of imported U.S. goods don't get too high and trigger more inflation and put us back in this mess. Also, Canadian inflation is down now to 2%, which is the benchmark. So it leaves the door open for our Bank of Canada to make a more aggressive cut on the next one. I hope that they do to get this going a little bit faster, but we also have some new mortgage rules that are going to shake things up for sure. Do you think we'll get a 50 basis point cut on our next meeting in October?
I'm still on 25 basis points. I don't think that we get 50 basis points at this point, although I think that inflation is much lower than what the Bank of Canada was expecting. Up until last week, we were hearing maybe 2.4%, 2% next week, 2% now. But going forward, the comparables for inflation, the year over year comparables for inflation are not as aggressive, where it'll be difficult for us to be below 2% or at 2%. So I think it is possible we see higher inflation going forward. And I think that would be more conducive to a 25 basis point rate cut.
Yeah, I think 25 is safe and we seem to be chugging along safely. But we'll see, employment numbers factor into it as well. And employment numbers don't look great. So I think that we could have it. I think that the headlines in the next couple of weeks are going to probably give us hints on what the Bank of Canada is going to do. So let's get into these new mortgage rules by Chrystia Freeland, our finance minister. Let's go over the rules first, and then we'll get our reactions. So the new mortgage regulation, so this is the 30-year amortization available for all first-time buyers on insured purchases. So this is previously, if you had less than 20% down, the maximum purchase price you could go to, 25-year amortization was the only thing available on insured purchases, so with less than 20% down. The second factor here is that insured mortgage cap is rising from $1 million to $1.5 million. So if you had an insured mortgage, your maximum purchase price in the past was $1 less than $1 million, and now it's jumped up all the way to $1.5 million. So it's a huge increase in purchasing power and type of property that first-time buyers can purchase. And the last one that is sort of a question for us is, will we see a change to the down payment requirements for insured mortgages? In the past, it's been 5% of the purchase price up to $500,000, and then everything over $500,000, it's been 10%. Will we see it stay at 10% all the way up to 1.5 million? Anything you want to add there, Sean?
Yeah. One other wrinkle was that all insured new builds can get 30-year amortization. So meaning that if you purchase something, even if you're not a first-time home buyer, as long as you're buying a new build, you can put less than 20% down and get 30-year amortization on that. I know you were saying before we got on that, well, what difference does it make, right? Like you can always put 20% down. You have to put 20% down on a new build.
Typically you do. And I was talking to somebody at our mortgage kickoff last week, and he was suggesting that because builders are having a hard time selling all the inventory in a pre-sale, that some of them will take less than 20% now. So it could have a factor, but I just think it's just a very, very small
Yeah, I think
impact.
that's the smallest change of all. But people don't. You can put that deposit down, 20% deposit, and then get a mortgage over. Now you can get an increase in your mortgage and get some of that money back. So if you put the 20% down, you could then finance where you put 10% down, and then you get some of that money back on closing out of the mortgage, and then pay that off over 30 years.
Correct.
So I think the big thing there is it helps incentivize builders. So there's better rules, more people can afford it, and then essentially keep let's get some shovels in the ground, which we're trying to do.
Exactly. And I think that although it'll likely have a low impact, I think it's a good step in terms of incentivizing more building, because the only solution to this crisis at all is that we need more inventory available. I don't think that tweaking the mortgage rules and the stress test is going to help that situation. I mean, I guess the question that I would have, the question on my mind is, when we're thinking about this government that's been trying to cool off housing prices, and now we have this 30-year amortization for insured mortgages, and that we raise the cap to 1.5 million. In my mind, all this is going to do is drive up prices, that a $900,000 property can now sell for $1.3 million. It's great news for people wanting to sell their home. But what is it going to do you think, to that sort of entry level, detached, or even semi market in the GTA?
Yeah, I think there's no doubt that it will push up prices. We've had this glass ceiling at $1 million, where a lot of insured borrowers are with less than $1 million down won't go over that $1 million. So I think in 2025 we'll see that glass ceiling broke, and we'll see that starting to move up, where properties stayed in around that 950, 975. Now we'll have more options to go for $1 million, $1.025 million, $1.050 million, but we're not going to see like a massive increase like overnight of property values. They're still, tied to what people can borrow and afford. But where it does open the door is that people without generational wealth, without money being passed down from parents or grandparents, can compete. So it opens the door for more people to buy an average home. In Toronto, that price is average selling price right now is $1,074,000, and in Vancouver, that's almost $1.2 million.
Yeah.
So an average family buying an average home, they weren't able to do that. They had to buy something under that $1 million, because it's going to take them a decade to save $200,000.
Yeah.
Right?
Yeah. I mean, it's that down payment, that 200, or, on a 1.5 purchase, that's 300,000 that in the past people would need down. So getting some relief there, I think, is a good idea. But I think that what it will happen, and I do think it'll be overnight, is that anybody selling a home, in the 1.1 range in the past, is going to really be able to ask a lot more for it, because there's more money now flooding the market. Like, this is a government that pumped the market full of money during the pandemic, and it just doesn't seem like they've learned their lesson at creating more money. We go right back to inflation. We go right back to high house prices. So I don't know if they really gave it as much thought as they should have.
I mean, I see your point. I see that, the government definitely put money into the economy. But I don't think this is going to have the immediate impact that you're thinking it's going to have. I think the Bank of Canada would be delighted if housing prices went up a little bit now. They're not worried now about inflating the housing market because inflation is falling so quickly. They're hoping that the economy doesn't falter, that we don't have a hard landing or go into recession now. And essentially, like, speeding up the housing market is ideal. We've had some of I think the slowest 2 years that we've had in decades
Since the
in the
90s.
housing market
Yeah, it's
right
been
now.
it's
So
been
it's
challenging.
less, it's now's the time to do it. They always had to increase that insured maximum purchase price from $1 million. Like, that was designed to be like, wow, $1 million home. Like, that's crazy. That's a lot of money. Now, a million's not a lot of money. The
It's
average home
true.
is much more than that, right?
Yeah. Yeah,
So
you
if you're
think when
going
you
to
were a
do it,
child, a
now's the
million
time.
dollars would get you like the Fresh Prince of Bel Air mansion, and you know what? It will in a lot of places in the U.S. And Toronto. You know,
Sure.
maybe it'll get you 1,200 square feet.
But even now, like $1.5 million, you're not thinking, wow, that's a mansion, right? Like, that's a maybe an above average home at 1.5 million, but there's plenty of homes that are 1.3 million or 1.25 that are in average neighborhoods, average family neighborhoods
For
in
sure.
Toronto, at least.
Now, here's my concern. I have a lot of clients that are first-time home buyers that purchased based on the old rules. And now they can't just upgrade because they're not entitled to get the 30-year amortization on the property because they're not first-time home buyers. These rules are like so heavily favor first-time home buyers, which is great. We want to help them, but we don't want to penalize the people that were doing it correctly or had to follow the old set of rules. Like, I wonder if there'll be any exemptions coming, because I think that what this will introduce is the ability to skip some of those rungs on the property ladder. People don't have to start off with a condo with these new rules, as long as the income is there, because they can go right into potentially purchasing their forever home on their first purchase. Do you think that this will incentivize? Do you think that we'll see people who purchased in the last couple of years, insured under 1 million, maybe not the property that they would have wanted, they would have been able to qualify for something better? Do you think this is going to upset people?
No, well, maybe, but I don't really care. I think that, like, there certainly are people that may have been able to afford more, but they are home buyers now. They've benefited from the housing market over the last couple of years or year, whenever they bought. And so they have already benefited from that. They've already gotten, they're already paying down their mortgage. They've already been in a better position. So this pushes their property values up, gives them more flexibility, more equity in their property when they're moving up to the next property, because those properties will all go up. I don't see how, we're not going to make a rule change for them. Well, if you bought in the last, 375 days, that all of a sudden now, well, this rule, it's just too complicated. I
I
don't
wonder
see,
why
it's
that's why
not
they
rung skipping.
push the start date out to December 15th. I mean, I would hope that what this window of time between now and then gets us to is that they can look at the criticism that's going to come from this stuff and maybe make adjustments. Like,
What
specifically,
criticism though? I don't see where the criticism comes on this program. Like, this benefits so many people.
it
Like,
potentially can. I mean, you still have to be a pretty high income earner, right? And to get all the way up to that 1.5 million purchase price.
right.
But it's the lesser down payment, right? So if you bought in the last couple of years, the market has been flat or down, you would have paid off potentially a piece of your mortgage, but you're not going, if you were insured mortgage on your first property, you're not going to get up to $300,000 in equity over the last few years. That's like impossible. So that upgrade is not available to those people. Sure, they're in a property and that's great, but it's going to seem unfair to them. So I think it will be a big deal. I think the criticism will be there, and hopefully they have a little bit of room to maybe make some provisions for not just first-time homebuyers.
I don't see that happening. And I mean, I think that any criticism for that group, like, that's such a small group of people that bought in the last 2 years, that now want to move up and can't move up.
Or even
You
at
know,
the
if
end of
you're
their
buying,
term, which could be
if
a
you're
2,
buying
3 to 5
real
year term,
estate,
right?
you're buying it for the long term, right? So you're not buying it for 2, 3 years. There's a big chance that you're not going to be able to move up in 2 or 3 years.
So
Like
I think with these new
things happen.
rules, those people are going to be looking and they're going to say, "Oh, we could have had that house if the government made this regulation when we were buying." Um,
Well, you can't cry over spilled milk, right? Like that is what it is at this point. Rules happen, rules changes happen. So to be able to go now, their property values will be pushed up. More first-time home buyers can now
that's
get
true.
30-year amortizations, right? So their property value that has been flat over the last 2 years, all of a sudden will start moving up.
But they
I,
can't really upgrade. It's not going to be 300,000. I mean,
why? They make more money now, right? Like they've
but on their
that
next
person makes
purchase,
more
they're
money than they did 2 years
required
ago.
to put 20% down. So I think that you could make an exemption. It doesn't have to be just first-time home buyers. That's my point, is that we can just open it up to insured mortgages are now able to put less than 20% down on a 1.5 million purchase price.
If that was the case, if you were saying that, okay, now everybody can do less than 20% down, you'd be saying that we're juicing the market too much. Like you'd be
I
on the
think
other
we're
side
all,
saying, oh no, this is too much for everybody.
you're
Like you
not going to
can't have
make me
it both
happy,
ways.
Sean. It's not going to happen.
This is crazy.
So
Where's
let's
Kristen? We need some
we need
like
balance.
buffer between us at this
Yeah, it's
point.
the gloves they're off, and we're swinging for the fences here. Now I looked at this and say, okay, who are the winners here? Like I say, well, first of all, CMHC, which is a government-owned insurance agency, they're going to win because I don't know what the premiums also are going to look like. I would assume that as we get more information as we go forward, we'll clarify the down payment rules. Is it 10% all the way up to 1.5 million, or will they try to slow it down? Because I mean, when you look at if you go all the way up to a 1.5 million dollar purchase price and you put the minimum down, which is 125K, that represents 8.4%. So homeowners are going to be struggling to build equity if they go all the way to that max. And I don't even think that's what Canadians do. Most of my clients set up reasonable amounts of debt for themselves, right? So I don't think that everybody's going to be swinging for the fences there. But that's so little equity. So are the down payment rules going to stay the same? The other factor is the maximum insurance on an insured mortgage is 4%, right? Are they going to increase that percentage for over $1 million purchase price?
Yeah, I've heard like, well, we don't know, right? So there's
We
no,
don't know yet. No.
So I've heard, at 4%, the maximum insurance premium goes from 37,000 to 57,750. I have heard that premium being increased from 4% to 4.2%. If we're up over a certain dollar amount, but that's
Right.
all just speculation at this point. There's
No, it
there's
wasn't
nothing.
released in the initial news release. So, I mean, we do have a lot of questions. This stuff will potentially get ironed out. But I mean, the insurance companies are going to clean up on it. So to me, I see it as a little bit of a problem, especially when it's the government that's announcing these changes. I mean, certainly the lenders are going to love
But
it.
there's two private insurers too, right? So there's CMHC. They're not even the biggest insurer anymore, right? There's two other insurers that will privately benefit from it. But it's
Sure.
across those three organizations all charge the same insurance. It's not like one's going to benefit or the other. There's three different products. And then you're saying, okay, like right up to 1.5 million, then that's a very small number of mortgages.
I think that you're right there. I don't think that we're going to see a ton of it. I mean, I did some loose math based on today's interest rates. In order to get up, if you had the minimum down payment, your household income needs to be about $300,000 annually in order to get you to that $1.5 million purchase price. So that's not that common. It may
How
become
much
more
was it?
common.
Sorry, how much was it?
Roughly 300,000 if you factor
Yeah.
in, your property tax on those properties, and I mean that's potentially even condo fees because that's potentially townhouses as well. But that's quite a lot of household income that you need to qualify for it. But so the lenders are going to love it because the lenders get bigger debt and more interest payments if they go with a 30-year amortization.
Well, it opens up that 1 million to 1.5 million to more lenders, because it's really been the big six banks that have had that market cornered for years now. As we've gone up over a million, the number of insured mortgages has declined. Like, we were in the like 30,000 to 40,000 insured mortgages per year across Canada. We're now closer to like 17,000 since 2022. So that's fallen off a cliff here. So
Yeah.
less people are taking that. The insurance companies win because now they've got a product to offer now. Very few mortgages in Toronto over the last little while have been insured. So they win, but not in the same way as like, oh, now they're just padding their stats even more. They're just getting some skin in the game. But I think the lenders are really like more choice. Borrowers win because there's more choice over which lender to go to. Rates would come down as there's more competition. So we're going to see our, what's called our monoline lenders, or our First Nationals, our MCAPs, RFA, RMG, all of those lenders all of a sudden will have a product that they can offer to those buyers of average homes in Toronto.
Yeah, it should definitely make that more competitive, and we definitely want that as well. We want as many competitors in the space. Hopefully, that does lead to lower interest rates. I mean, there's always been a premium interest rate charged on properties over $1 million. Now that may get challenged as well. I do wonder if there's more regulation coming for, let's say that if you do have 20% down on a purchase over $1 million. That was always considered uninsurable. So you had to pay a premium. I wonder if there'll be regulation changes surrounding that to make that easier for people that do have the down payment as well.
But your rate's going to be higher. Your rate will be higher if you have 30-year amortization, because it's not insured, or it's not insurable, right? So, I think that's the mind, or sorry, if you have less than 20% down, you will get a lower rate than you would if you have 20% down. I think that will be because you then have the insured cost on top of it. It's not a benefit to you to get that lower rate and put less than 20% down.
But it means lower payments, though. It puts more money in your pocket.
If you put less than 20% down and a lower rate.
Yeah. I mean, I wonder if it'll lower the rates across the board for purchases over $1 million, because there's been a premium charged in the last, I don't know, since the B20 rules came out.
Well, if you have less than 20% down, you would have a lower rate, but you would pay insurance. So it would cost you, the cost of
And a bigger
borrowing would be
mortgage.
higher.
Yeah.
So
for sure.
So monthly, it should be a wash, but it should be still in your benefit to put 20% down, but I haven't done the math on, and we don't know what the rates are.
I think they will still see a big portion of buyers putting the 20% down. Get rid of that. Absolutely. I mean, if you're talking about a $50,000 insurance payment, and let's be clear, this is you paying insurance to protect the lender from you. Like, it's unfavorable on the palate, certainly.
Yeah. Well, it's to protect everybody, right? So if there's a run on people defaulting on their homes because property values have gone down, they're unable to pay their mortgages, that protects the banks. That protects then the Canadian economy, because the banks are such an important piece of that. It's all tied together. So it's protecting you from yourself, but it's protecting all of us to give us a healthier Canadian economy, safer Canadian economy.
I hope so. I think that when we put a little bit too much emphasis on the insurance companies to protect us, that we get into a problem that looks maybe a little bit similar to the housing crisis in the US. It's sort of one of my big concerns about this program. If this program, takes off like a rocket ship, is that we have homeowners with very little equity in their properties, and then insurance companies that we're relying on to keep everything, fair and safe, and lenders feeling a lot less risk. So lenders could potentially, the risk isn't on them anymore for purchases over $1 million. Like, it's a huge relief for the lending community, but I'm not sure that sets up the best environment for the economy and the housing market in general. Are there any other risks that you could see there? I mean, that basically outlines sort of my thoughts about it. Only we're like 3 days into this new regulation.
Well, I think those are all good points. I think having more risk for the insurance companies, you are putting more risk on the buyers. I think, what we always say is Canadians pay their mortgages. So we have so few defaults as it is. And even like as property values have declined and for some people's property, some people are underwater right now and they put 20% down, but they continue to pay the mortgage and it is a long,
But
it's a
that
long game.
20% down, that equity, that skin in the game helps to make sure that people don't walk away from purchases. I mean, $125,000 is a lot of money. But if you've got a $1.5 million property and that drops to, I don't know, 1.2, I guess that's a housing crisis that we can't even foresee. So maybe it's not worth getting into that. But
yeah, well, 2006,
when you own 8% of your property instead of 20% of your property,
right,
it just creates a different environment.
Yeah, 2006, 2007, 2008, you could do 0% down and 40-year amortization. Like,
it creates a problem.
Yeah,
when you
2008,
have
we had a
longer
housing crisis,
right?
Yeah,
and less to no down payment. It doesn't incentivize people to stick around when times get hard.
Yeah, but we went through a housing crisis in 2008, and we were like Canadians went through that no problem. Certainly, defaults increased, but it wasn't crisis level by any
Not at the
stretch of the
same level as the
imagination.
U.S., but I just think that this little piece of legislation pushes us a little bit closer to that.
We're so far from that though. Like there's so much more of a down payment that you still need compared to I don't think we'll ever go back to 0% down, but like that was on anything. On a rental you could do that as well. Like they're really trying to incentivize the market to put money into the house.
It was unscrupulous in the U.S. and we did a better job here. So maybe I'm not trying to fearmonger, but it's in the back of my mind.
The fear is in the back of your mind at all times.
It's always there, Sean. This is what we have to do as mortgage brokers, and we're trying to help people manage debt and make responsible decisions. And I think that our government hasn't thrown that out the window. But is it a little bit edging towards we have an election? Look at us, we're helping the market. That's always on the back of my mind as well. Is it great policy? Let's get an overall reaction. Sean, do you approve or decline this new legislation?
100% approved. I think like these are actual policies that will help people compared to other policies that we've had over the last little while. That will have no effect. This will help a lot of people get into the housing market.
All right. I'm going to decline this one. I'm sending it back. It needs some revisions. I think that increasing the cap from $1 million to somewhere over $1 million, I think this is a great idea. I think it's a long time coming. I think that maybe increasing it by 50% is too aggressive, that maybe just edge it up to 1.2, see how that goes. I think 30-year amortizations on insured purchases, either make it available to everybody or make it available to only people that have the 20% down payment. So it needs some tweaking. I think it's too aggressive. I think it's a little bit sloppy, but so I'm going to send it back. It's a decline for me, but there's a lot of good stuff in there. It is going to help families get into properties sooner than if they had to wait to try to save up the money. So overall, not bad. It's not exactly how I would have drawn it up. Anything else you want to cover this week, Sean? I think that we really hit this thing hard. I think if anybody, is asking these questions, they should tune into this podcast, check out our responses. I think it was well thought out, and I think it'll help some people out.
Sounds good. Yeah, I think it's a really important topic. I think we'll probably talk about this again next week. What effect does it have on the stress test? I think we'll just have to get into that next week, and we'll go from there.
Sounds good. All right. Hopefully Kristen will be back with us next week. Sean, it's been a slice. I'm Vaughn. We're mortgage people.